Let's have a look at some results coming out of the JSE Securities Exchange, notably from Super Group. These are the annual results to the end of June of 2013. Here we go. Revenue up 15%, operating profit up 22%, headline earnings per share up 19%, adjusted up 22%. And after a difficult trading period, it says, the results seem very good to me. On the telephone now is the CEO of Super Group, and that's Peter Mountford. Peter, no dividend declared. Just before we get into the numbers and your divisions, is that because you want a war chest in case of bad times? Are you looking at some acquisitions, or are you just going to continue repurchasing your shares?
I think it's really a culmination of the policy this year to continue repurchasing our shares. But without doubt, we'd like a war chest in terms of organic growth that we predict into the forthcoming year, as well as some potential acquisitive opportunities.
Good. It's always good to acquire during difficult times because you might get a few bargains. And you do say that you've endured difficult trading conditions. I'm reading from your SENS announcement today.
Yes.
And also intensified competition. So I suppose, given the results that I've just read out, you've done extremely well.
Yes, we have. We're very happy with the way the results have come out. But there's no doubt that the consumer is under spending pressure in South Africa, and we've seen very little real growth in volumes within our supply chain businesses. I think it's really a tribute to a number of new customer accounts that we obtained during the current year, as well as complemented by some of the acquisitions.
You mentioned FMCG, fast-moving consumer goods. How important is that to you? In other words, we've just seen some results out from ShopRite. They've done well, but undoubtedly the South African consumer is under pressure, so therefore less FMCG movement. How does that impact your business?
It is significant to us. It impacts our business across most of the supply chain operations. So certainly a softening in consumer spending, or the current sort of levels in consumer spending, do impact on our supply chain businesses broadly. And all the more, I think it's a good performance from that division to be up at 86% growth on profit before taxation level.
Indeed. Let's have a look at those divisions now. You've mentioned supply chain, but maybe embellish that before we get on to fleet solutions and dealerships. So start with supply chain, if you would.
Right. Well, I think the supply chain performed very well, a tribute really to a number of new accounts that were obtained across the business, both in terms of fast-moving consumer goods, industrial products, white goods, and the related. We also had some good performances in our bottom-end distribution businesses, as well as an excellent performance in our short-term truck rental operations. On the technology front as well, our technology business, VSC Technologies, has implemented a number of systems on an international basis. So overall, I think the division did very well to record the type of profit before taxation growth that you've seen in the numbers.
And Fleet Solutions, you picked up a couple of good contracts there, I understand.
Yes, I think SG Fleet Australia performed exceptionally well. Obviously, Fleet Africa is a disappointment from our perspective and did step back on the prior year. And that's really a function of the loss of two major contracts in the previous year. But that business performed quite well as in the context of those losses. I think Australia was very heartening, and we saw a significant pipeline of new business coming to maturity in the Australian operations. And importantly as well, Australia runs businesses in New Zealand and the United Kingdom, which are making positive contributions for the first time now as well.
How about dealerships? Because if you have a look at the NAAMSA numbers, every time I speak to someone from NAAMSA, they say that last year, I think new car sales grew at just under 10% for the year, and they were being fairly cautious about their projections for this year. I think something like 8.5%, if I remember correctly. How is that going?
I think the dealerships performed exceptionally well. We grew new car sales in those operations by over 22%. But I think, if one looks at it on a comparable basis and backs out the 3 or 4 dealerships that we did purchase in the year, we achieved a 16% growth in new car sales on a like-on-like basis. And that's an excellent performance in relation to the NAAMSA increase of some 8%. I think that is also a tribute to a service excellence program that was introduced in the dealerships last year in an endeavor to try and increase the car park contributions from maintenance services and financing activities.
Just in the last couple of minutes, Peter, let's have a look at the outlook now. And I've sort of made some points when I read your results. The first one is the highly competitive trading environment continues to place pressure on the group in terms of consumer sales volumes and securing new contracts. And the way that the JSE is performing towards your share price today suggests that, yes, they think your numbers are good and you've done well, but that's in the past. And in the future, your cautious outlook is being punished.
I think we are obviously cautious. There's no doubt the consumer is under spending pressure in terms of fuel price increases, tyre price increases, potentially toll roads and other issues. We are not at all negative going into the forthcoming year, and I think we certainly embrace the challenge to generate some good numbers into the forthcoming year.
Peter, just on that Sanral e-toll system story, which seems to drag on, if it does go ahead, again, I asked you about FMCG slowdown of movement of goods. Is this going to be a big whack for you?
It won't directly impact on our profitability per se, but it does mean that there are additional costs that pass through to the consumer and will only pressurize consumer spending into the forthcoming period. So we are concerned about it, and it certainly adds a significant cost to the cost of distribution in Gauteng.
Peter, we'll have to leave it there, but thanks very much for making time this lunchtime. That's Peter Mountford, who's the CEO of Super Group, whose year-end results came out earlier today.